If you operate through a family trust or you're thinking about setting one up, the tax holiday is officially over. The ATO has shifted from pandemic era leniency to what they're now calling a large scale crackdown on 7 specific areas that affect how wealthy Australians structure their wealth. Right now, there are 271,000 private tax groups in Australia managing 1.3 million entities like trusts and companies. The ATO believe these groups owe 11.2 billion in unpaid tax, which is 20% of their total collectible debt. And in the last month of 2025, the Deputy Commissioner of Private Wealth stood on stage at the Tax Institute's annual conference and made it clear. If you're using a trust to get ahead, you're now under the microscope. So today, I'm breaking down the 7 targets the ATO has announced for 2026, the mistakes that are costing families the most, and the one insider move that could reset your position before the Amnesty deadline hits at the end of this year. First, let's talk about why this is happening now. During COVID, the ATO extended what tax advisors are calling a tax holiday. They went soft on compliance because the government told them to help taxpayers survive. But that grace period officially ended on 30 June 2024. And according to a tax partner who used to work at the ATO, the pendulum has now swung in completely the other direction. The actions are now being compared to what happened after the global financial crisis. Basically, the ATO helped the community through an event and then immediately cracked down on compliance afterwards. If you're waiting for them to soften up again, you're probably looking at another 2 to 3 years minimum. Here's the math that should wake you up. If you've made a family trust selection error, even one that dates back to 1999, and you've distributed money outside your defined family group, the ATO can hit you with family trust distribution tax, which is a tax at 47%, not your normal tax rate, 47% flat, plus interest going back to the date of the mistake. And for one wealthy South Australian family, this mistake has already resulted in a $13 million tax bill for what they thought was an innocent error. So the stakes are high. So what are the 7 things the ATO is targeting? Let me break them down fast. Target number 1 is family trust selections. If you made a family trust selection back in 1999 or any time after, and you named the wrong test individual or you distributed to someone outside of the family group during a succession event, you've got a problem. The ATO has introduced an amnesty that ends 31 December 2026. If you self-report and pay what you owe before then, you can avoid up to 80% of the interest charges. After that, they keep the full amount. Target number 2 is holiday homes. The ATO released draft guidance in late 2025 that says if your beach house or mountain retreat is mainly for personal use and not genuinely available for rent during peak periods like Christmas or Easter, they're disallowing your deductions. That means no more claiming mortgage interest, council rates, or repairs unless you can prove it was genuinely available for rent for most of the year. Target number 3 is income splitting. Accountants, lawyers, doctors, architects, and tradies, if you're splitting income through a trust or a company to divert it to family members on a lower tax rate, the ATO has updated its guidance on personal services income rules. They're specifically looking for substantial distributions to associated lower tax persons. Translation, if your spouse is on the trust payroll but not doing the work, that's on their radar. Target number 4 is Everett assignments. This is for partners in big consulting, accounting, and law firms like KPMG or EY. If you're reporting less than 50% of your total distribution from the firm as your personal income, or your overall effective tax rate across your group is below 30%, the ATO has flagged you. The grace period to fix this expired June 30, 2024. So they're expecting to see changes in your tax return this year. Target number 5 is philanthropy. If you've set up a private ancillary fund and you're funneling money back to related parties or employing family office staff through the foundation, the ATO released a draft determination in December 2025 saying that if the funds erode the true value of the gift, your deductions will be cancelled. Target number 6 is the Bendel case. Now, this is the big one that everyone's watching. The High Court is deciding whether unpaid present entitlements, or UPEs, constitute a loan under Division 7A. If the taxpayer wins, it could blow open a loophole the ATO thought it closed back in 2009. If the ATO wins, thousands of small business owners who use trusts are going to face additional tax bills. Target number 7, the 45-day holding period for franking credits. If you set up a bucket company for tax planning and it receives franking credits, but the company didn't exist 45 days before the dividend was paid, the ATO is denying the credits. A recent case even involved franking credits worth many millions of dollars being clawed back. So watch out. Now, here's the move most advisors aren't telling you, because it requires you to act before the deadline. The amnesty for family trust elections is the single biggest opportunity you have right now to clean up any historical mistakes without getting destroyed by interest. But here's what's critical. The amnesty only applies if you self-report before December 31, 2026. If the ATO finds the error first, you pay the full penalty plus interest dating all the way back to when the original mistake happened. So here are your options. Self-report before December 31, 2026 and pay the family trust distribution tax owed. Interest will be reduced by 80%, but if the ATO finds it first, you pay the family trust distribution tax owed, full interest, which could be 15 to 25 years worth, plus penalties on top. So if you think there's a chance you distributed to the wrong person during a business succession, a divorce, or when you brought in a new business partner, get it reviewed now. The difference could be hundreds of thousands of dollars in interest alone. There are 2 additional things the government is doing beyond the ATO's enforcement actions that you need to know about. First, Division 296, the new super tax. Starting 1 July 2026, if you have a super balance between 3 million and 10 million, you'll pay an additional 15 percentage points of tax on your realized earnings. That takes your total tax in the super fund to 30% for that portion. If you're over 10 million, it's an additional 25% tax, bringing your total tax on the portion of earnings to 40%. This hasn't passed Parliament yet, but the first financial year it will be payable will be 2027, 2028, which means the clock is ticking if you want to restructure before then. Second, the CGT discount inquiry. There's a Senate selected committee inquiry into the 50% capital gains tax discount that's been available since 1999. Their report is due in the first quarter of 2026, which is right now. Labor has tried to pare this back already in 2016 and then again in 2019. And the inquiry was prompted by the Greens. If they reduce or remove the discount, anyone selling investment property, shares, or business assets after holding them for more than 12 months will pay significantly more tax. So you're not just dealing with the ATO enforcement on the 7 targets, you're also dealing with 2 new government tax grabs that hit the same group of people. The ATO has made it clear they're not just targeting the top 500 wealthiest Australians anymore. They're using what they learned from auditing the ultra wealthy and applying it to the next 10,000 and then the next 50,000 taxpayers. If you already have a trust or a super balance over 3 million and you want us to review whether you've got any family trust selection errors, exposure to Division 296, or opportunities to restructure before these changes hit, I've left a link below to book a strategy call with our team. We'll go through your setup, check for red flags, and show you exactly what needs to be fixed before the deadlines. See you in the next one.